I got that there. Let me try.
I gotta give you, all right. You are now the host.
Okay. Perfect.
Hey, I was working on this guy's warrant and his GPS went back on right now, and then it's at low battery again.
Guys, you need to mute unless you're asking us a
Yes, it just goes like but he's barely been charging it though, Portia. Like it restarted yesterday at 21.
You need to mute.
And then at 10:23 this morning.
I just muted her, sorry.
Oh, thanks. Yeah, I couldn't do it because I gave you.
Sorry, Elliot. All right, so let me just make sure I need to pop this in the right. I'm just going to adjust my camera so I have the presentation on the same screen. Can you guys see me all right there? Perfect. Okay. So my name is Dakota Kallas. I am a lender with American Pacific Mortgage. Today, I know this has been kind of a topic that not a lot of lenders have talked about. It's manufactured financing and some of the solutions and just things to know, both from the listing side and the buyer side. So without further ado, I will jump right into this here. Let me see if I can, there we go. Okay, so to introduce myself again, I work with American Pacific Mortgage. I've been in the industry for about 2.5 years now. I've done quite a few loans since then. I've worked with Chase for about a year, so I've been on the bank side. I have also hung my license and worked as a broker for about 8 months. And so I kind of have experience from both sides of the industry on the lending, in lending. Current company I work for actually does both bank and broker. So it's kind of the best of both worlds, which is why I ended up moving over here. My co-host is not here today. She's on a business trip, but Nikki Shaw, she does the homeowners insurance side for financing for manufactured homes. I don't know if you guys know, but it is hard to get insurance. And there's a lot of nuances with manufactured homes, both in the financing and on the insurance side of things. So if you have any buyers that are looking to get insured, she is a great resource. And we'll try and do, if there's a lot of questions today, we may do a part 2 of the financing, and we'll try and loop in the insurance side. So that way we can get those questions answered on the insurance side as well. But that is our info there if you guys need it. And this PowerPoint should be shared with the team once we're done here. So a little bit about us. Our company, APM, has been around for over 20 years. Our slogan is "We bring people together." Basically, we design and create an experience around our clients and partners to make sure that all the way through the process, whether or on the buy side, that it's smooth, that there's communication, and that's kind of what we value there. To dive into just kind of the outline, we're going to go over just a little bit about our company, what we do. We're going to go over buying versus renting just real quick. And then the big meat and potatoes of this presentation is going to be about the financing, right? So we're going to go over all the different types of financing for manufactured homes. And then we'll just go real quick into how to qualify and the loan process itself. If at any point in time you guys have any questions, please feel free to speak up. I think you can take yourselves off mute, but if not, just raise your hand and I'll take you off mute there. And that way we can kind of facilitate any questions, but I will definitely have some time at the end for questions as well, because there is quite a bit going on in here. Okay. So just one thing to think about, again, with the type of company and the lender that you're working with, there's really 3 different types of lenders, right? There's mortgage bankers, there's banks, and there's mortgage brokers. So just a little bit of positives and negatives about each. With mortgage bankers, typically they control the process. They do have competitive rates, and they do have a superior appraisal process. They have their own AMC they work with, but a lot of times they're limited to their investor pool. On the bank side, and again, I've worked for a bank as well, so I can really speak to this. They fund their own loans. That's one of the positives. Again, they have their own guidelines, and they can look at customer scenarios between their checking savings very easily, and they control the process from approving, underwriting and funding. But and I can speak to this because I did this during COVID for the bank. They do have a lot more stringent guidelines and a lot of overlays. They do have limited choices of programs you can use, and rates are kind of in or out of the market depending on how hungry that bank is at the time for business. The last one there is mortgage brokers. So I don't know, I'm sure a lot of you guys have worked with mortgage brokers. I've been a broker. I've loved being a broker. You have access to multiple programs. The nice thing about a broker is you have really competitive rates. But the things that you do lack on the broker side is just control of the transaction. You're basically a third party reaching out and getting the financing with the lender. And from there, the lender has full control of the process. Depending on the lender you go through as well, there's not a lot of communication. So you may or may not see brokers not communicating as well as they should, because they a lot of times don't have the answers they need. They don't underwrite, draw docs, or fund their own loans. That's all done through the lender. Again, one of the things I said at the beginning, with American Pacific Mortgage, it's kind of the best of both worlds. And the reason why I came here is we both broker and we bank. So depending on the specific scenario, I may have a client that I will take through our bank route because we may need to work through underwriting to get a certain exception done or to control the speed of the process all the way through closing. And that's a lot more manageable on the bank side. But we also broker to some of the best wholesale lenders out there to get competitive pricing. So it's really scenario based, but that's really one reason why I came to American Pacific Mortgage, is the ability to have both, as well as a team to help me get those done. Okay. Just real quick, advantages of buying versus renting. And again, we all know this, but when you buy, property taxes and mortgage insurance are tax deductible. Your property appreciates over time. You have control over any improvements you want to make, and you have the pride of ownership. Renting, I mean, it's like 100% interest, right? You're not building any equity anywhere. Your money is not working for you, and the value is not appraising, and you can't make improvements to the property typically. So it's great for your landlord, and it's great for people, saving to buy. But I always recommend, even if you have to pay just a little bit more, to be able to pay towards principal and have the value of homeownership. Cool. So this is the meat and potatoes. I wanted to get through the other stuff quickly so we could truly cover a lot of the financing, because this is going to take up most of the time here. So there is a lot that goes into financing for manufactured homes. Some of it is similar to single family homes, and then some of it there are different nuances. So we can typically do both conventional with loan amounts. I think in our area it's 647-200 through Fannie and Freddie. Government sponsored loans we can do VA, FHA, and USDA. Now, I'm not going to touch too much on this. There are first time home buyer programs. They're very limited down payment assistance programs with manufactured homes, and honestly, down payment assistance at the moment is very hard to attain. Even if we can get a client under them, they're costing so much in points and fees to do them that the client, in the end of the day, does not get much from the down payment assistance itself. It's covering most of the cost to do it. So that is not necessarily the best right now, but again, that will change as the market adjusts a little bit. And then we can do non-QM portfolio loans. So anything that doesn't fall into the conventional or government sponsored loans, we call it non-QM, subprime, and we can also offer those as well. And there's some great great loans in that aspect that we can do, especially when it comes to manufactured housing. That's actually really cool. So I'll dive into those different topics here as we go along. So just to kind of jump in on a conventional loan. So this is typical with manufactured housing. With conventional loans, there's just a few nuances we need to know, and then we can go over loan to values and things like that. We do have to have an appraisal done on the property. And that appraisal type is a 1004C. It's specific for manufactured homes. And this is one of the regulations you're going to see a lot when you're dealing with this. It's 24 CFR Part 3280. All that's stating is that we can only finance manufactured homes that have been built after June 15th, 1976. So anything done prior to that, conventional and government loans won't work. You're going to have to go the non-QM route. We're going to jump into this as well. It's certificate of a fixture, as well as engineering certifications. On a conventional loan, that is actually dependent on, so the certificate of a fixture always has to be there. The engineering cert is going to be dependent on the underwriter's discretion. Apologize for that. I have a dash that should be drawn out different, but now some of the things to consider when we're looking at a conventional loan for manufacturing. Here's some of the properties that are not eligible, right? Anything less than 400 square feet, we can't do. Any homes that have been previously installed on another site or location. So I think I've actually had an agent within Bliss who's had a manufactured home that's been moved once before. Well, you can't get conventional financing on that. If it's been moved, it is disqualified from conventional as well as all government loans. The only route that you can go is non-QM portfolio. And so that's something when you're either listing a manufactured home, or if you're on the buyer side, that's something you definitely want to check into is, has the property been moved? Since its manufacture date, since it came from the manufacturer to the lot and it was, it has its affidavit of a fixture, has it been moved somewhere else? That's a really key question to ask the sellers, or to ask the listing agent to make sure that you're setting up your buyer for success. Okay. Now, again, I just mentioned manufactured homes produced prior to June 15th, 1976. We can't do them on this product. And we also cannot do leaseholds on conventional. So if you have a manufactured home that's in a park, right, where the client does not own the land, they just own the manufactured home itself, that's technically not considered real estate. Real estate is the property being affixed to the land. And so if it's on a leased land, that you can't get conventional financing that way. Okay. Some of the key things that your clients might be interested in, if they're looking to buy, for a primary residence, they only need to put 5% down. So that's a key thing there. It is 5%. That can come as a gift. So that's something that it is nice there. They do have to have a 620 or higher credit score on conventional. So that's just some of the guidelines there. As far as cash outs go, so you can actually do cash out refinance on primary residence, okay? But the loan to value, you can only go up to 65%. So if you have clients that, are looking to do a refinance on a manufactured home, they do have to have an appraisal done, and they can only go up to that 65% loan versus value, okay? 620 again is a credit score there. A lot of people don't know this, but you can actually get second homes. So if you have snowbirds, people who live up in Canada or just different parts of the country and want to come and spend the winters here in Arizona and enjoy the better weather out here, second homes are available for financing. I believe just like this shows here. So Freddie Mac, you can go up to 85% loan to value, meaning the client would need to put 15% down, and then with Fannie Mae, I believe it is 90%. Okay. Now we can finance single wides. So that's something you may want to think about, but there's some restrictions with single wides. So for example, on a cash out refinance, single wides are not eligible. Okay. On secondary homes, we basically can't do single wides at all. And then we can only do single wides with Fannie Mae, okay? And doing a single, let me see here, 15, 20. Yeah, so that's where we'll go there. Let's move on to the next one. So that's conventional, okay? When you're listing or looking at contracts, that's the requirements for the conventional side. Here's the requirements for government, okay? With government, we can do FHA, VA, and we can also do USDA. I have it on the next slide. There just wasn't enough room here. But with FHA, your mortgage insurance is insured by the government, okay? Same, just like with a standard single family home. Down payment again, 3.5% with 100%, gift funds allowed. The nice thing about FHA on these ones is with conventional, it's like 620 for the guidelines there. FHA minimum credit score is 580. And we can also do 30-year terms on FHA, just like conventional. This is for primary occupancy only. You cannot do second homes. You can't do investment properties. Now, here's one thing that I do want to mention. Again, affidavit of a fixture is always required. the engineering certification, and we're going to actually dive into each of these topics because they're definitely things you want to look for, but an engineering certification on a government loan, at least FHA, is always required. Okay, so if you're, let's say you're a listing agent and you get an offer for FHA financing on your manufactured property, you need to make sure that you have your buyer, or sorry, your seller has that engineering certification completed. Otherwise, it needs to be completed. And I would recommend, as a note for those who are taking them, have the engineering cert done and completed prior to the appraiser coming out to the property. If the appraiser comes out to the property, sees that there's an issue with the tie downs, and then the engineering cert came out and they came out and fixed everything, right? The client paid and had everything fixed, and the certification shows that it is completed. The appraiser may still be required to go back out to the property to re-verify that's completed prior to, you know, actually having the appraisal complete. So it would be one of the prior to conditions instead of as is. For the appraisal, it costs more money for everybody, or for the buyer, not ideal. So I just recommend, you know, making sure that you have that done initially, and make sure that the manufactured property is affixed to the ground. Okay. Also, you may have to update the affidavit of a fixture if they've gone through and added like a big decking, things that may have either been bolted to the property or changed the way the home is sitting, or if they have, like I said, additions, you may need to go through and update your affidavit of a fixture. With VA, so we can do VA on manufactured homes as well. It's 100% financing. They don't have to be first-time home buyers. Again, there's no mortgage insurance. We can go up to 30 years. Just like FHA, it's primary only. On this one, though, the difference is the engineering certification is not required unless it's a new manufactured home that was just placed on land. It needs to have at least one, or as deemed necessary by the appraiser or the underwriter. Okay. Again, just like conventional, so properties that we can't finance with FHA or VA is anything that has a lease produced prior to 1976, June 15th. If the home was moved from the original location, and we can also not do any type of renovation loans on manufactured homes. Okay. Now jumping into, again, those guidelines. So for primary, or for the primary there, it's 9.65%, meaning they're putting 3.5% down. Now if they're getting secondary financing, they can technically go up to 105, but 580 is the big ticket item, and we have to pass the automated underwriting system review. So, you know, let's say, for example, you have a buyer who does not have or has not maintained payments on a government loan, for example, student loans. We may need to set up a payment plan and show that they've made their first payment in order to pass what we call CAVers in order to get the financing to be approved. So there's a lot of, you know, that can go into it, but I just recommend ensuring when you're the buyer's agent that you're working with the buyer and making sure that the lender is staying in communication with you as far as what they need to do to get the buyer in a position to qualify. Okay. All right, let's see here. And then I believe, let me see, VA, 100%. And I'm sorry, on VA, we can do a cash out refinance, just like on FHA for the primary. FHA is 80% loan to value, and the VA is actually 90%. So you can go up to 90, leaving 10% equity in the home. So that's actually, if you have clients that are in VA, 90% is an awesome, that's truly awesome. So especially now with clients who may have already had a loan and they're looking to take equity out, that might be a good option for them. Typically, VA rates are a little bit lower as well than you know, conventional and FHA. Now let's jump into USDA. One thing I'm going to mention too, so guidelines change all the time. So if this video is being recorded, I always recommend checking with the lender before just taking this as gospel and going with it. It's important because, again, there's overlays that happen all the time. We saw this during COVID, where they started placing overlays because of where the economy was going, making sure, you know, it was hard to get a lot of people financed. I work at Chase. I know they treated people like numbers and they denied loans like crazy because they're looking, again, they're a bank. They're looking for the cream of the crop per se. But you always want to make sure that you're checking with the lender at the time that you have the right guidance and the right lending guidelines there. Okay, USDA. So USDA is a little specific. The nice thing about USDA is it is 100% financing. Just like a VA loan, if they have benefits, that's also 100%. USDA, you don't have to be a veteran for, right? But it does have to be in a qualifying eligible area. You don't have to be a first-time home buyer to buy, but with USDA, it is income driven. So there are certain income guidelines that they need to meet for different household sizes in order to qualify, okay? And that does change every year. So again, check with your lender before to determine what that guideline is, how much they need to make, and if your potential client fits that guideline for USDA. There may be different grants as well. I have to look into manufactured homes for that, but there may be grants to even help cover closing costs. But the one thing with USDA is it has to be a new manufactured home. Okay, they will not finance anything that's used. It has to come straight from the manufacturer and be placed on land. So it's actually more of a construction loan in the sense that they have to develop the land, make sure that there's a permanent foundation to place the manufactured home on, that it's affixed, that it has utilities, electrical, it meets all the different requirements and guidelines for that area. Water can change. I know in certain areas there's hauled water versus digging a well. So with USDA, it's very specific. It needs to meet that area's primary source of utilities. Credit score on this one's a little bit higher. It's 640. And then let's see here. It does need to meet or exceed the FMHCSS standards for the area. I apologize. I don't know that acronym off the top of my head, but it's a standard for the area to make sure that it does fit into that category so we can do the financing. Okay, this is the fun one. So non-QM portfolio loans. This is what happens when we have a manufactured home that's been moved. If it doesn't meet typical conventional or government financing, this is the next step that we would look at in order to get financing. So I split this into two screens. One of them is secured by land. The other is leased, manufactured homes on leased land, okay? For homes that have been, or that you own the land, the manufactured home can be moved twice, okay? So if we have and this happened with an agent within Bliss, if we had a home that was built in 1996 and it was moved in 2013, well, you can't get conventional or FHA financing through there because it's been moved. But we can do that through a non-QM loan. So there is financing, and I'll go over the requirements there. This is a requirements for one company. I have more than 3 or 4 companies I could potentially take this deal to, so we can still try and get competitive on rate. But again, it's more of a lender-specific program, okay? But we can do single, modular, multi-section. It can be moved twice. Homes that are built to HUD standards that are 14+ feet wide. Land does have to be owned fee simple, and the title needs to be eliminated. Let's see, hold on. Title elimination must be completed. So yeah, it can't have a title, right? It needs to be fixed to the new piece of land, right? It needs to be real estate. Here are the loan terms for that. So we can do up to 25 years financing. There is no loan limit, which is great. They do have to do a full appraisal. So they're going to do a full land and home appraisal there. Loan to value. So the client has to come in with 5% of either the purchase price or appraised value, whichever is less. That's how lenders look at, the financing portion anyway. Credit scores are a little bit higher. So we would have to have a client that has a 660 credit score to hit that, minimum in order to hit that guideline. With debt to income, there's what's called a front end debt to income ratio and a back end debt to income ratio. Front end is any of the housing expenses. So if you're looking at principal, interest, homeowners insurance, I don't think this is going to be in a planned unit development, but if there's an HOA, all of that gets factored into the front end debt to income ratio. The back end is then looking at not only the new housing expenses, but also factoring in the other customers' debts, okay? So we can't go above 45% on the total debt to income ratio, but we do have to hit that front end debt to income ratio for housing as well. And then the last thing, the rate commitment on this program is 90 days. So once we go through and get under contract and we lock the rate, that rate is then, that's the rate commitment for that next 90 days. Now, this is something, again, that's kind of a unicorn of a loan product, okay? Most lenders will not even deal with a manufactured home that has been moved. This program is awesome in the fact that we can actually offer that. This other program is even more of a unicorn. We can actually finance manufactured homes that are in parks, that are on leased land, okay? Again, we can finance multi-section or single section that are built to HUD standards. They can be new or existing. And then it can be either a primary home or a secondary vacation home. Let's see here. That's one of the things that's really cool is technically the manufactured home in this scenario is not real estate. It's technically a vehicle. There's going to be a VIN number. But that's because it's not tied to land, but we can still get financing. And this financing is a lot better than a lot of the other lenders I've seen out there will do up to 10-year terms or 15-year terms. They'll go up to 20 on this one and their rates are typically better. So that's kind of one of the really cool things about this. This program is, this is kind of one of those unicorns that we can offer for clients. There is no loan limit. The land, basically, they are still going to do, and I believe not land, I apologize, but they're going to do appraisal on the property. That does have to be ordered by the lender. Again, they do have to put 5% down, and it's going to be 20% if they're doing a second or vacation home, and the rate commitment is also 90 days. So if you have, like, again, not everybody's going to run into these types of loans where the manufactured home's been moved, but as a listing agent or a buying agent, you want to make sure that you're asking these questions up front. You know, has the home been moved? What is the age range? Does it have a HUD label or a plate or a tag that you can go look at? And some of this information may not be, you know, as easy to find. So I recommend if you get a client that's looking to list their manufactured home, go and get all of this information up front. It will make your life and your seller's lives and potentially the buyer on the other side and their agent, it's going to make everybody's lives easier. Okay. Now, so the top 3 things that I recommend, at least having information for on the buyer or the seller side is the affidavit of a fixture. This actually gets, you can request this from title. So basically the title should get that from the county assessor's office or however they pull the information there. But an affidavit of a fixture, just as a definition, is a document that's used to change the status of the manufactured home from personal property, basically coming from the manufacturer, right, to real property, being tied down to the land. So that's basically meaning they're removing, you know, any wheels, they're cutting off the trailer hitch or the tongue, and they're doing everything else to make sure it's secured and fixed to the, you know, to a foundation. That's what the affidavit of a fixture is for. Like I said, that does need to be updated if you do additions or anything else to the home after the fact. Okay. You go through and complete this by going to the MVD with the title of the unit. Once the MVD is verified that it's signed, that the affidavit of fixture is signed, it will need to be recorded with the county. So that's typically the process there. If you have a client that just bought one and is placing it on a piece of land, that you know, help them with, things like that. Okay, let's continue. So retitling, if you, again, lending side, we don't really look at this, but just for helpful information, if you have a client that, you know, maybe wants to buy another piece of land and move their manufactured home from their current, you know, land, or from, you know, a park, well, I would say probably current land, over to their new piece, right? They have to go through a retitling process, and they have to go and get everything set up as if it's a vehicle, again, where it's registered, it has a VIN number in order to move the, you know, the vehicle, right? Then once it gets to the new piece of property, it needs to be reaffixed to the land. So it needs to go through and be tied down and get a new affidavit of a fixture before you can get any financing in general. And again, once it is moved, you cannot do conventional FHA, VA, or USDA financing your best bets are to go non-QM or portfolio lender route. Okay. All right, so that's it for the affidavit of a fixture. Now jumping in, this is another key item that you're going to see. Basically, the manufactured home engineering certification. Okay, this is basically a certification that's provided by an engineer or architect, and this ensures that basically the manufactured home is structurally sound and that it's tied and fixed to the ground. So a lot of times, and again, I've worked with quite a few agents that have actually listed property. We're in the middle of the process, and then we realize that there is no tie downs, or one of the tie downs has either eroded away or is no longer compliant, and they have to go pay somebody to go re-tie down that fix that tie down, or go through and do all of them again. It's not cheap to go do, so it's something that when you're listing the property, it's a good question to ask. Make sure, okay, let's look and make sure that it's tied down. And then it's good to even go get that engineering certification done up front. But again, it does depend on what financing route we're going, because it may or may not be required. If it's already in there and the appraiser goes and looks at it and it's tied down, there, a lot of times on a conventional loan, they won't worry about it. It won't be a requirement based off the appraisal. But if they go through and do an appraisal and see that one of the tie downs are faulty, they will request, it will be a condition that has to be closed. They'll have to have a certification done to verify it's valid. And then the appraiser will have to go back out to verify before they can close the loan. And that can really extend the time frame of closing. So these are good questions to really think about up front for those specific reasons. Okay. For FHA, like I mentioned, this is always required. For VA, it's required for new properties or when determined necessary by the underwriter or appraiser. Again, for USDA, it's always required because we will only finance new manufactured homes. So that would be the first engineering cert. And then lastly, with conventional, it's as required by the appraiser or underwriter. All right, and then the last big key thing that we want to make sure we look at up front is the HUD label verification letter. So a lot of times you'll hear like, hey, does the manufactured home have the tag with it, right? That's what they're talking about, is this tag right here on the right. If it does not have the tag, for example, I had a client that was, in between Kingman and somewhere really far out there, right? And he owned land, he had a manufactured home. They replaced the siding of the manufactured home. He still had the tag or the plate. He just had it in an envelope. He didn't reattach it to the property, and he had since gone through and done renovations to his home, so he didn't have the label, the data plate on the performance certification on the inside in the cabinetry. So we had to go through and reorder a new label and send it, even though he had it. The underwriting and appraisal was very specific that we needed to do a new one. So that's something to think about. We need to ask, okay, is there a tag? If there is not, we need to order a label verification letter. Basically, it's going to include the label number, serial number, date of manufacture, the manufacturer and plant location, and then the location of the first destination, whether it went to a dealer or a retail center or the homeowner. Okay. Now, when you go through and order this replacement, they're not going to just give you a metal plate, a new metal plate or tag. This verification letter is basically industry recognized and accepted document for verification of that information. And if you actually Google IBTS for manufactured homes, the first website that pops up, you should be able to jump in there and actually order this, or you can just have the lender do it if it's not there. Data plate and performance certification. So again, for this one, one thing I missed on that, I just went to the IBTS website and pulled timeframes. So if you request one 10 days out, it's $50. If you rush that label verification letter, it's about 100. And if you need it the next business day because you're 3 weeks into your contract and this needs to be done ASAP so that we can get out of clear to close and over to closing, you can rush it. It's about $175. Okay. Now, for this one, the data plate or performance certification, this is for the interior. So if it's missing from the interior of the manufactured home, you're going to get either a data plate. We're looking for a data plate or certificate, or sorry, compliance certificate. If they don't have it, you can order one. And let's see here on this one. Let's see. The performance certificate can be used as a substitute for the data plate. So if they don't have the data plate on the inside, we're going to order the performance certificate. And again, on this one, $100 for 10 business days, about 125 for 3, 175 for 1 business day there. All right. So that is all I have on the manufactured housing side. Just a couple of keynotes. I'm going to run through these pretty quick because I know a lot of you have already dealt with this, but if we have anybody that's new, this is good information. Typically, when we're qualifying somebody for a loan, we look at 3 things. We look at the credit. Most importantly, we look at employment. That's super important there. We look at assets, and then we look at the property itself. When I'm going through and talking to somebody initially, income is like #1 by far, because that's something that we need to have the history there. We can always try and finesse assets. We can figure out how to improve credit, but I can't help a client with income, right? So how the FICO score is calculated. This is just for awareness. 35% payment history, 30% amount owed. In use and new credit is about 20%, and then total credit history is about 15%. Every company that you're looking at may have a slightly different variation on their algorithm, but we go through the top 3. It's Experian, Equifax, and TransUnion is what we look at when we're pulling scores, and we do a hard credit inquiry. So we'll go through and pull scores and make sure that the client fits those categories. Again, for most products, we want to try and have clients that are at 620 or above. Technically, the minimum, I think, on conventional for not like single family homes is 600. For manufactured was 620. FHA again is more like 580. The VA is dependent on their basically the AUS system, but we also want to make sure there's no, what we're looking for anyway is no judgments or tax liens, and we want to make sure they have an active credit line. A lot of times we can try and supplement. If they don't have enough credit or they've paid everything off. I had a client the other day that literally did not have a credit line since 2011, and so we actually recommended that we couldn't get a score, so we recommended that client actually jump on as an authorized user with their parents who have on-time payments, and she was just an authorized user, and then we actually used utilities to help cover on-time payments to make sure the underwriter was okay with the deal. So having some sort of credit is good. It's less risky for the lender to show that you do use credit, and we can show that you're making on-time payments. Now I'm going to jump into specific periods for derogatory events. So basically, when you're qualifying for a loan, the big things we're looking for also are for, have they foreclosed on their home in the last 7 years? Have they done a short sale? Do they have a bankruptcy? When was the discharge date for the bankruptcy? What was the bankruptcy type? Chapter 7, Chapter 13. So we look at all of these different factors when determining whether or not a buyer is going to qualify. Again, the nice thing is if you have a client that has discharged a bankruptcy or just foreclosed on a home and it's been closed, there are non-QM lenders out there that will do financing for those. Will it be a little bit more strict on potentially credit score or certain factors? Yes. But if you have a hard deal or a client's been denied, send them our way. We can at least look at them and see if there's an alternative source for lending, instead of just denying the client and telling them, hey, come back in 4 years or come back in 7 years when we can do the loan, or if they qualify FHA 3 years, right? Send them our way. We're actually happy to look at them and see if we can go a different route. The next big one, like I said, employment. So realistically, there's 2 things we look at. We need 2 years of employment, whether you're employed, you're an employee collecting a W-2, or if you're self-employed, we need 2 years of tax returns, okay? Those tax returns can be Schedule C, 1020s, or 1065s. If you own over 25% of the business, we do need your separate business, your personal tax returns and your business tax returns for self-employed. Okay. If we're looking at W-2, to be really honest, we collect 2 years of W-2 statements, and we collect 30 days of pay stubs. If we need to use bonus income or commissions, things like that to qualify, we'll collect the end of year pay stubs for the last 2 years and do an average to try and determine how much of that income we can use to qualify. Okay. Assets. So this is a big one. Especially right now, typically we have down payment assistance programs that are really good. At the moment, with how high rates are, again, I think this is going to be the new normal. And rates are actually not in a horrible position, but things are still we're still kind of adapting to the higher rates. It's been a fast increase. And so because of that, pricing for rates are still high. With down payment assistance, typically the rate is higher, but then you get a down payment to help cover those closing costs. You know, you're a lot less out of pocket. Well, right now, down payment assistance, I mean, it costs quite a bit to even do. So typically, and again, don't hold me to this, but clients are typically getting, 1% or maybe 2% at the moment when we're trying to run through these. So it is a little bit more challenging to get at the moment. But when we're looking at assets, we're looking, do they have enough money for a down payment? Do they have enough money to cover closing costs? Depending on the deal, there may be certain reserve requirements, especially, and I know this was the case during COVID. If you were self-employed during COVID, I remember when I was working for the bank that there was 12 months of reserves in an account just to qualify self-employed client. So, I mean, it varies, but reserve requirements may be required depending on whether or not they're buying investment, primary home or secondary home. So that's something to consider as well. What we're looking at for sources of down payment, it can be checking, savings, stocks, mutual funds, money market accounts. We can even look at, and I've done this before, I actually did this myself, not going to give advice here, but we can look at 401ks, IRA accounts, rollover accounts to potentially use towards down payment. If you're a first-time home buyer, there may or may not be a certain percentage of that down payment from your retirement that they will not charge a fee on because of being a first-time home buyer. If it's 401k, you may still have to pay taxes on that, but they may not hit you for a certain portion of that as a fee because you are a first-time home buyer using it as a down payment. You still work for the company. You may even be able to take a loan out on your 401k to help put a down payment on a home. So we get creative when we're looking at trying to determine which route we can go for a client to get qualified and have the funds to close on a home. Okay. The last one is gift. So I've done this quite a bit. I've used gift funds from, it does have to be from family members. So, parents, grandparents, cousins, uncles. We will go through and look at it and determine, depending on the loan product, what we can use as gifts there. Okay. And again, the biggest thing with gifts is we have to show a paper trail. So there has to be a letter basically stating that they are not going to owe any money back to their family member. And we have to show the paper trail from the money leaving that family member's account to the money going into the client's account for down payment or closing costs. The only way we don't need to see if it goes into the family members or the borrower's account is if they send the money directly to title. Okay. And it goes directly into that escrow account. Then we just need to see the wire transaction to show that it went through. Okay. Last one with appraisals. Obviously with appraisal, the best type of appraisal you can do is on a conventional loan. It's a lot less strict per se on what they're looking for. Whereas VA and FHA, there are more specific requirements. Roofing has to be good. Basically, there has to be appropriate grading. You have to have a safe water and sewer supply, right? Handrails even. I've seen some funny photos of one step needing this like tiny 6-inch handrail. There's some weird nuances with these loans, but again, they're great products. It's just when we're going through the appraisal, there just may be some additional hurdles that we need to overcome there. Okay. But we basically look for on the appraisal, we're looking at either the appraisal, basically when we're looking at financing, it's the lower of either the appraised amount or the purchase price amount. So if the home doesn't appraise, we're going with the appraisal amount, not the purchase price, and doing the down payment from there. So if the client has a certain down payment amount and the home did not appraise, they may or may not have to come in with the difference. Okay. But yeah, so those are the different things that we look at when going through and qualifying a borrower. The last thing I'm going to cover real quick is the loan process, and then we should be good for questions here. But typically the way the loan process works on a purchase is we start with that pre-approval. We talk to your clients, right? Or if we got clients, we'll get them connected with you. We get them pre-approved, and then we start the home buying process. We look for what they're looking for, and we make sure they get under contract. Once they get under contract, what we actually do is review the rates, fees, everything with the client. We'll send out initial disclosures, which is the loan estimate, so that they can go through and sign all of those documents. And then we collect all of their documentation, the W-2s, pay stubs, if they own a home, then mortgage statements, all that information we need, package it together and send it to processing. What processing does is they go through and make sure we have all the title documents. They make sure that we have an insurance quote. And then what we'll do is then package this and get this ready for underwriting. Depending on the lender you're using, some lenders will actually go through and hold off on ordering the appraisal until after the inspection period to make sure that we didn't spend money and then the client didn't like the house and backed out, right? So a lot of lenders will wait until the inspection period is over. They'll order the appraisal after we know there's a commitment there. And then the package goes to underwriting. Now, underwriting can be depending on your team, right? I have a great team that gets everything done kind of on the front end. But once it's in underwriting, they'll do their initial underwrite review. What happens from there is your loan will then, if the client still qualifies, your loan will then, or their loan will be conditionally approved. It means the underwriter approves based off their initial review, but they have certain conditions that need to be addressed, or basically questions, documents they need to verify the client is qualified. Once they go through and get all of those conditions removed, the final underwriter on the loan will then issue what's called a clear to close, and they will pass that document off to the closing team. Now, before that clear to close, once we get to a certain point with documentation, they can issue out what's called an initial closing disclosure. And that's what starts the 3-day time frame we need to have from issuing the initial closing disclosure to actually closing and funding on the deal. And so that typically will happen in underwriting. We do have to make sure we hit that 3-day window. If they get a new loan estimate during this time, you need to wait 1 day for the loan estimate and 3 days for the closing disclosure. But once the loan is conditionally clear to close, it goes to the signing, closing department. They work with title to schedule signing, closing, and funding. And then we basically receive the, let me see here. That's where we'll receive the final loan approval. The lender will then let everybody know that we've funded and that we're closed. Okay, and that's the end there. So I know this was a lot, but that is basically the process as a summary of what we do at American Pacific Mortgage for manufactured financing, the different options that your clients have, whether on the listing side or the buy side. You know what options there are for financing on the property based off of those scenarios that we talked about. And then how to make sure your borrower, or what we look at to make sure the borrower is qualified to get to closing there. So again, my name is Dakota Kallas, work with American Pacific Mortgage. If you have any financing questions, we can jump in and answer those. And if you have any insurance questions, I recommend writing down Nikki Shaw's information. She's a great resource. She's very knowledgeable on the manufacturer side of things for insurance. So if you have buyers that are looking to buy a manufactured home, I would speak with her prior to even getting under contract if possible, or within the inspection period, to make sure that we can actually get insurance on the property. Okay. But yeah, is there any questions that you guys might have? I don't know. Let me see here. Let me see if I can pass.
There's just a lot of info.
Yeah, sorry. It was kind of a lot. but I know that we were recording this so that anybody that, you know, needs to reference back to it down the road, there's a lot of information, you know, how to get the right financing, to know those specific talking points on, you know, okay, if I have a listing that's coming up, here's the things I need to know about this listing before I actually put it on the market, because you don't want to put it on the market, not have certain items, and now this home's sitting on the market for, you know, 30 days before you even get under contract, or worse, you're under contract and you need 60 days to close.
Can you work in Tucson?
We can do financing. I can do it all around Arizona. I'm also licensed in California, Utah, and soon to be Texas.
Okay.
But yeah, I see a lot of these actually, and maybe you guys do as well, but I see a lot of manufactured housing on land out in Maricopa, Casa Grande, Eloy, Arizona City. That's primarily where I see a lot of these deals going through, but I know they're becoming a lot more popular now with the higher housing values. People are like, hey, or with COVID too, people are like, I want to get out of the city. I want to get away from people. My neighbors drive me crazy. I just want my own piece of land, and I just want to throw a manufactured home on there. So I've talked to a lot of clients looking for that, and barn dominiums, which are becoming popular now too. So
yeah.
But is there any other questions that any of you guys might have in regards to the financing? Do you have any deals that you may be listing that you have certain questions on before you actually post it on the NMLS? Okay. I will say, if you have a question, please reach out to me, even if it's a listing, right? And you want to make sure that the deal is set up in the right way to where you're going to get the financing you need. Reach out to me. I'm happy to help. I've done that before for agents with Bliss. I just want to make sure that, again, you're avoiding that headache that you can run into dealing with these, because there are more nuances with manufactured homes than there are with just a single family home. But once you understand, again, like I mentioned, the affidavit of a fixture, engineering certification, and the HUD plates, those are the big ones. If you understand those, you're sitting pretty good as far as being able to list these and start doing a lot of these deals. Those are the three big topics that I see most often when dealing with those properties. So.
That's great. Thank you so much, Dakota. That was super helpful. A lot of things to look at too before you list. So
right.
Problems later that even I wasn't aware of. There's so many, and these sellers with these mobile homes never have half this information. They're like, I don't know. I'm like, how did you purchase it? And you didn't say anything.
Right. Yeah, I know. I've worked with a couple agents with Bliss that are going through this process, and it is a headache. And to make sure that, like, it's really nice to avoid a lot of this headache up front by getting the right buyer too, right? If we know we can't do conventional financing or FHA financing, we want to make sure that it's listed, hey, alternative financing available, but we don't want to accept one of those deals and then watch it blow up mid-process, or, you know, it's just not it's not a fun process to go through. Let's just leave it at that. But I'm always happy to help. So
appreciate that. Well, thank you so much. This is great.
Yeah, no problem. And if you guys have any additional questions, we can send out my email. I'm happy to answer those, field those questions for you. Hopefully avoid some of those headaches, you know, down the road.
Great.
All right.
Thank you.
Thank you.
For the time. Appreciate it.
Thank you.
All right. Take care. Thank you.
Bye.
All right. Bye.
Bye.
Let me see if I can.